Still getting a weird screen. I'll stop this share again. All right, so today we are going to continue our work in chapter 1. We're going to be learning how to prepare some financial statements today, so we're going to be doing a goodly amount of problem solving today. We'll not get 100% through chapter 1. I have a little bit left to wrap up on Tuesday, but definitely on the 15th, we will be spending most of the session on chapter 2. Right, but again, those two chapters really go together. So we left off last time mentioning that our chief communication tool, the way we communicate financial information with external users, are the financial statements. And in the remainder of our work in chapter 1, we're going to be learning how to prepare the income statement and the retained earnings statement. We'll learn how to prepare the balance sheet in chapter 2. We'll talk about the balance sheet in chapter 1. We'll talk a little bit about the statement of cash flows. But balance sheet preparation will come in chapter 2. And you'll learn how to prepare the statement of cash flows next semester or whenever you take accounting 2. We will not work on preparation of the statement of cash flows together, although we will discuss the purpose of that financial statement. So we're going to be jumping pretty much right into problem solving today, because the first of the financial statements that we prepare is the income statement. The financial statements need to be prepared in a very discrete order because information flows from one financial statement to the next. And we start the preparation process with the income statement. All right, it's a relatively simple financial statement, at least until we get to chapter 5. When we get to chapter 5, we're going to make some big changes to the income statement. The format of the income statement that we learn in chapter 1 is referred to as a single step income statement. In chapter 5, we're going to make some big changes to the income statement. But for now, it's a relatively simple financial statement. It is a report on the result of operating activities. One of the last things that we talked about on Tuesday were operating activities as we envisioned the life cycle of a corporation. An income statement, the primary purpose is to summarize those results, right? To summarize the inflows of cash and the outflows of cash resulting from day-to-day normal recurring operating activities. Right? All financial statements are classified. Right? The income statement, from a big picture standpoint, at least what we learn of it in the first chapter, is relatively simple because there are only 2 classifications: revenues and expenses. And revenues and expenses are what we call classifications. Classifications are somewhat similar to chapters in a book. They group related information together. Right? So within a classification on a financial statement, you present information about individual accounts. But revenues is not an account. Revenues are a classification. Expenses are a classification. Right? So revenues minus expenses is the format of the income statement. And if A business is successful if its revenues exceed its expenses. The business has net income. If the business is not successful, if revenues are less than expenses, you have a net loss. So the income statement is a summary of operational success or failure. Right? You have a good specimen to study in your text on page 1-10, but we are going to learn how to prepare this document line by line. So we're going to learn the proper way to prepare an income statement. So we're going to jump right into some problem solving. So if you have printed the in-class exercises for chapter 1 from Blackboard, go ahead and get those out. This is what the first in-class exercise looks like on the handout. And I really do encourage you, if you're able, to print these out on paper so that as we're working through problem solving together, you can be working the problem. I think you'll find that you're going to learn a lot more if you actually work along with me when we do our guided problem solving. I think you'll find that that's going to be more useful than just passively observing. Right? And on those in-class exercises, I've given you accounting style working papers to make it easy for you to do the work. Right? This document that you see here is what we call a 2-column ledger. A 2-column ledger. Now, yes, I know there's 3 columns here. We call it a 2-column ledger because we put dollar amounts in 2 of those 3 columns. Right? So when you print these working papers out, or these in-class exercises, I should say, you'll have accounting style working papers that are appropriate for the problem. I've also given you a Word document in Blackboard that is just one big giant 2-column ledger, so that as you do additional practice on your own, you can print out blank 2-column ledgers. Right? You'll typically use a 2-column ledger format when you produce and prepare income statements. Right? So the Word document handout is going to look a little bit different than the Excel spreadsheet that I'll be using as we work through this exercise. But I wanted to show it to you because I do think it's very useful for you to print these out on paper so that you can work them along with me as we go through guided problem solving. So I'm going to pull up a slightly different version, right, in Excel. So when you are doing problem solving in accounting, it's very, very important to read first and write second, maybe even write third. Right? You want to make sure that you study and analyze your data first. You definitely don't want to just start writing, because you get partway through the problem and realize, oh, you left something out and you have to start all over again. And it's often very, very helpful when it comes to problem solving to start with the instructions, because that can help you focus your information, or focus your attention, I should say, on the most important parts of your data. Right? So our data tells us, or our instructions rather, tell us that after analyzing the data, and it even tells you, analyze first. Prepare an income statement. Now, we haven't talked about a retained earnings statement yet, so we're going to be focusing right now on income statement preparation. We're going to prepare that income statement for the year ending December 31, 2009. Right? So we're going to keep that in mind. We're going to keep those instructions in mind as we analyze our data set. Our goal is to prepare an income statement. So we know, because I just told you, that income statements have revenues on them and expenses on them. So we have to analyze this information. We have to look at all these accounts, and we have to decide which of these go on an income statement and which don't. And it's very, very important for you to understand that in a problem, in any given problem, whether it's pen and paper problem, in-class exercise problem, exercise in Wiley Plus, every piece of information that's given in the data set may not be necessary. Part of the process of problem solving is deciding, is this information needed or is it not needed? And you will definitely have problems where you will be given data that is not important to the solution of your exercise. We refer to that sometimes as a red herring. That's an expression in the English language that just means something that's thrown in just to confuse you, right? To see if you can tell the important information from the unimportant information. Right? So as we analyze these different accounts, we're thinking, does this go on an income statement or does it not go on an income statement? Right? And becoming familiar with the different accounts in accounting and knowing where they go, which financial statement they are reported on, that's a key competency in the first two chapters. And in chapter 1, it's pretty straightforward. Revenues, the account name typically has the word revenue in it. Expenses, the account name usually has the word expense in it. So at least in chapter 1, it's pretty straightforward. If the account has the word expense in its name, it's an expense. If the account has the word revenue in its name, it's a revenue. Now in chapter 2, we're going to learn that that's not always true. There are some accounts that have the word revenue in their name that are not actually revenues. There are some accounts that have the word expense in their name that are not actually expenses. But we really don't encounter them in chapter 1. All right? So we have to go through and classify and decide, does this go on an income statement or does it not? And retained earnings, January 1, 2009, it's not a revenue, it's not an expense, so we can ignore it. It doesn't go on an income statement. Materials and production expense, however, that has the word expense in its name. So that's going to go on an income statement. Marketing and administrative expense has the word expense in its name. So that's going to go on an income statement. Dividends declared, though, doesn't say expense, doesn't say revenue, because it's not. Dividends are not a revenue. Dividends are not an expense. Dividends are profit sharing. So not an income statement item. But sales revenue is a revenue. So that'll go on an income statement. Research and development expense has the word expense in its name. That'll go on an income statement. Income tax expense has the word expense in its name. That'll go on our income statement. And other revenue has revenue in its name. So now we know which accounts are going to impact our income statement. And we're told to prepare an income statement for the year ending December 31 of 2009. And it's worth noting, this is actual data from the 2009 financial statements of Merck. Right? Merck's a pharmaceutical company, right? Fairly good sized one. So these are real numbers. They came from real financial statements. And we have a very, very important piece of information right here. All dollar amounts are in millions. All right, so that's very, very important. We are told that these are not whole dollars. Merck didn't have $27,000 worth of sales revenue. They had 27,000 in millions. What's another word for 27,000 million? Anybody?
27 billion?
$27 billion in sales back in 2009 for Merck. That's a lot of sales. That's a lot of drugs. All right. So it's very, very common for the big publicly traded companies to report their financial information not in whole dollars, but in thousands of dollars or in millions of dollars. Right? And Merck is reporting in millions of dollars. Right? So there's a lot of rounding that goes into coming up with 27,428.3 in millions. Right? So here's our 2-column ledger. It looks a little different than it does on the handout because there aren't any line markings for the columns and the rows. I don't really have to have that in Excel because we've got this lovely little grid work in Excel. But income statements, at least for our purposes, we're typically going to use a 2-column ledger to prepare them. And at the top of the 2-column ledger, we have this long, thin, rectangular box. And the purpose of this long, thin, rectangular box is to prepare what's called a header. Right? Financial statements are not complete without a header. And our headers are going to have 3 lines to them. On the first of the 3 lines in our header, we're going to write the name of the company. We're going to write the name of the company in all capital letters. So Merck, oops, and company. And let's go ahead and add INC period. Right, the INC period just tells us the legal form of the business, the way it's organized. Stands for incorporated. So that just tells us that Merck is a corporation. If Merck was an LLC, it would say Merck and Company, comma, LLC. If Merck and Company was a general partnership, it would say Merck and Company, a general partnership. Right, but it says INC. Kimmel usually doesn't bother with the INC, but it does tell us the legal form of business organization. Right? So as you can see, roughly centered in the middle of the page and all capital letters. That's the first line of our header. The second line of our header is the name of the statement, income statement. And the third line is the time period covered by the statement. And there are 3 time periods in accounting: the month, the quarter, and the year. Just got to look at the instructions. They'll always tell you what the time period is. Often it's going to be a year. And if you ever had a problem that didn't specifically come right out and tell you what the time period was, you would assume it was for the year. But for the month and for the quarter, you'll have homework problems where you'll prepare financial statements for the month ended or for the quarter ended. But in this case, we're told for the year ended December 31, 2009. Now we can say for the year ended, we can say for the year ending, either way, 6 of one, half dozen of the other, whichever you prefer. Okay. So that is our header. But we need to do one more thing to this header. And it has to do with all dollar amounts are in millions. We have to present what's called a modifier. We have to tell the reader of this income statement that, hey, this is not in whole dollars. This is a departure from whole dollars. Modifier will be presented in parentheses after the name of the statement. So we can say in millions or in millions of dollars, whichever. It's actually kind of a little redundant to say in millions of dollars because Merck is a US company. And the unit of functional currency in the United States is the dollar. So US companies prepare financial statements that are on a dollar basis. But if you want to say in millions of dollars, or you can say in millions, in this age of global commerce, usually it's going to be in millions of dollars, but it honestly doesn't matter. Right? Another common modifier that you'll see is the word partial in parentheses. If you're only going to show the reader part of a financial statement, but not the whole thing, you have to tell them that, because that warns them that, hey, there's some stuff missing. All right. But in our case, we're going to prepare the entire income statement. All right. So
The header should have 3 lines on it.
typically 3, yeah.
Not like that.
Sometimes 4. You know, what I'm going to be showing you are what would be called best practices.
The one I printed doesn't have any lines. It's just a big rectangle.
Yeah, because
Okay.
it's a Word document.
Okay.
It's a little bit easier to have the grid lines in Excel than it is in Word. But in the real world, there is always going to be variation. Right? And it's impossible for me to show you every possible variation of an income statement format. So I have to try to show you what are the most common way to prepare it, the quote unquote best practices. But you should understand that there is variation in real life. Right? So typically a header will have 3 lines. Right? So we have 2 classifications on an income statement, revenues and expenses. Revenues are always presented first, and we're going to show the revenue left justified. Right? It's going to be aligned with the left margin of our 2-column worksheet. So we're going to write the word revenues aligned with the left margin of our working paper. Right? You could refer to this 2-column ledger as a working paper. Right? So once we have listed our classification, then we just put all of our revenues. Right? So if we look back at our data set, we see that we identified 2 different revenues. We have some sales revenue and we have some other revenue. So that begs the question, which one should we put first? the answer to that question is, well, there's really not a rule. Right? Accounting, particularly US accounting, is a very rule-based system. There's lots and lots of rules to accounting. But there's actually not a rule as to which revenue we should put first. But there is traditional practice. And quite honestly, a lot of things that we do in accounting, we do not because there's any rule, but just because that's the way we do it. That's just the way it's been done. That's the tradition of the practice. And a very basic tradition of the accounting practice when it comes to presentation style is to list things from biggest to smallest. All right, now, on some financial statements, the balance sheet, for instance, there will actually be rules for the way we list accounts. So next week, when we learn how to prepare the income statement, we'll encounter that. But when it comes to the income statement and the listing of revenues, there really isn't a rule, but there is a very firm practice of our profession, traditional practice, to list things from biggest to smallest. So I want you to view that as your default rule. If there's not a more special rule, list things from biggest to smallest, because that's just the way we do it. So we're going to indent a little bit, and we're going to write the bigger of our two revenues, which is sales revenue. All right, now the reason that we indent a little bit is simple, just to make it easy to read. We want it to be nice and easy to read for the reader. And if we just list everything all left justified, it's just hard to read. So we indent our accounts a little bit. Now we have two columns for numbers. We're going to put sales revenue in the leftmost of those two columns. So 27,428.3 in millions. And I'm going to put a dollar sign next to the 27,428.3 because it's the top number in the column. Right? The top number in each column is going to get a dollar sign next to it. And I did skip the first line, and I did that again just to make it easy to read. Right? There's no rule that says, hey, skip this line. I just skipped that first line just to make it look pretty, just to make it easily readable. When you're working financial statements in Wiley Plus, it's going to be blessedly easy because everything's going to be pre-formatted. And you'll have text boxes that'll already be there and drop-down menus, and you're not going to have to worry too much about formatting. Right? But for your practice problem solving, these are just some guidelines that you can keep in mind. All right. So our next biggest revenue was called other revenue. And that was 11,147.7 in millions. And as you can see, this one doesn't have a dollar sign next to it because it's not the top number in the column. We definitely don't want to put a dollar sign next to everything. That, again, makes it hard to read. All right, just a dollar sign next to the number that's at the top of each column. Now, these are all of our revenues. All right. So before we can go on to expenses, there's another traditional practice when it comes to financial statements. And that is whenever you have a financial statement classification that has more than one account, you're going to want to present a subtotal. Right, so I'm going to indent a little bit more, and I'm going to write the words total revenues. Total revenues. So this is our subtotal. Right, and I'm going to draw a single line under 11,147.7. The single line in accounting, when it's on a financial statement, has a meaning. And what that meaning is that we're going to do some mathematics to the numbers that are above the line. And in a lot of cases, that mathematics is addition. Financial accounting is not really super math heavy, right? Addition, subtraction, occasionally a little bit of algebra, but certainly no calculus, right? So we're going to add up these two numbers, but we're not going to present the subtotal in the leftmost of the two columns. We're going to extend that subtotal over into the rightmost of the two columns. So 38,576.0 are the total revenues for Merck in 2009. Right? Now note, $, because this is the first number in the rightmost column, but also note that if we show our information to one decimal place, we need to do that consistently throughout the entire financial statement. So even though the decimal is 0 here, we still want to show 0.0 so that we are consistent with our numbering. Now at this point, once we have completed our revenue classification, we're ready to move on to expenses, our second and final classification. Now you'll notice that I didn't skip a line here because I really don't need to, because the indenting makes it nice and easy to read. And I might have done this a little bit differently if everything was all aligned with the left margin, right? But the indenting helps to make it nice and easy to read. And we put this subtotal here just for the convenience of the reader, just so they don't have to get out a calculator and add up these two revenue items. Right? Everything that we do on financial statements is done to make it as useful as possible to the people that read it. Right? Even down to the formatting and the presentation style. Right? So, before we do the expenses, I want to show you what we would do if we only had one revenue item in the classification. And because I've shown you the presentation style for a classification with multiple accounts in a classification, now I want to just show you the way it would look if there was only one revenue. So let's pretend that the only revenue that Merck had was the sales revenue. The presentation would be a little bit different. Right? We'd still have the classification revenues. Even if there's only one account in the classification, we're still going to have the classification. Right? Even if you only have one sentence in a chapter in a book, you would still have chapter 1, chapter 2. Right? So we're still going to present the revenues classification, and we'll obviously still present the sales revenue account. But since there's only one, if there were only one revenue account, instead of putting the dollar amount in the leftmost of the two columns, we would put the dollar amount in the rightmost column. It would still get a dollar sign. Whoops, one too many. There we go. Would still get a dollar sign because it's the top number in the column. But we'd put it in the rightmost column. And there would be no need to indent and say total revenues, because that would just be redundant. If sales revenue is the only revenue, we don't need a subtotal. So we would go right on to expenses. So this is how the presentation style would look if there were just one account in the classification. Right. But for our example, we do have the two revenue. Okay, I guess I can't get back to what I had before. So I have to redo a little bit of work. 27, 428.3. And other revenue. $11,147.7. $576.0. Okay, so now we're going to do exactly the same thing with our expenses. So what is the biggest expense that we identified for Merck? There's a question about what other revenues come from. It's probably revenue that's not related to operating activities. So maybe Merck had some investment revenue, or perhaps they had some licensing revenue. It's probably revenue that's from a non-operating source. And that's maybe not going to make a whole lot of sense right now, but when we get into chapter 5 and we make some changes to the income statement, we're going to see that the income statement will have things in addition to operating activities. They'll have what we call other revenues and gains and other expenses and losses. And those are things that come from something other than the normal day-to-day operating activities. Right? So my guess would be that when it comes to a company like Merck, it's probably licensing revenue and maybe some investment revenue, but without actually opening up their financial statements, I'm just guessing. But it's non-operating revenue of some kind, most likely. Right? So for our expenses, we list them from biggest to smallest. Our biggest expense for Merck was materials and production expense. And we identified more than one expense. So again, we're going to put the materials and production expense dollar amount in the in the leftmost of the two columns, 9,018.9. Question about dividends. Right, dividends actually don't go on the balance sheet. All right, but we will learn in a few minutes that dividends go on the retained earnings statement. All right, at least dividends declared don't go on the balance sheet. All right, So we will be getting to dividends in a bit.
So we should actually be writing revenues and expenses in the row, right? Like the heading of revenue and expenses that goes in like one of the rows.
Yeah,
Okay.
yeah. These are what we call classifications,
Okay.
and they're important from a presentation standpoint
Okay.
because they tell the reader, hey, these are inflows, these are outflows.
Okay.
Yep, absolutely. All right. So materials and production expense, and notice no dollar sign next to 9,018.9 because it's not the top of the column. Right, 27,428.3 is the top of the column. Right. And we just go from biggest to smallest. Our next biggest expense is marketing and administrative expense. $8,543.2 in millions. Then research and development expense. $5,845.0. Whoops. Notice I did not abbreviate. No abbreviations on financial statements, no shortcuts. Right? Published financial statements are not going to have abbreviations. Right? Get into good habits. Write out the entire account name. Right? Dollar signs only next to the number at the top of each of the two columns. Do not put a dollar sign in front of every single number. Right? And our final expense, the dreaded income tax expense. 2002, 67.6 in millions. Merck paid 2.2, or they had, we don't actually know how much they paid, but for the period they're allocating $2.2 billion of income tax expense. All right, that's a lot of tax. So those are our expenses, again, from biggest to smallest, because that's our traditional default approach to presentation. Right? And we have more than one account in the classification. So we'll indent and we'll write total expenses. We'll present a subtotal for our expenses. We'll draw a single line under 2,267.6. Again, that single line means do some math. And the math that we're going to do is, again, addition. So here's a fun little old-timey accounting word for you. Foot. It's an accounting slang expression. When you say foot the column, that's just an accounting way of saying add up all the numbers in a column. Foot the column. I have no idea how that term originated. But when you say foot the column, you mean add up all the numbers in the column. So we're going to add up all the numbers for our expenses, and we're going to extend the subtotal over into the rightmost of the columns, of the two columns. 25,674.7 in millions. So we're almost done. At this point, another single line gets drawn under 25,674.7. And it again indicates math, but this time it's not addition. It's subtraction. Income statements are revenues minus expenses. Revenues minus expenses is going to give us either net income or net loss. All right. In this case, the revenue is bigger than the expense. So we say net income. And we do the math. We take the 38,576.0, we subtract the 25,674.7, and we get 12,901.3 in millions. Now we put a dollar sign next to the number that's at the top of each column. All right, so the top of the column in the rightmost column is the 27,428.3. In the rightmost column, 38,576.0. But the bottom line figure on a financial statement is also going to get a dollar sign. And we're going to double underline. All right, I know it's a little bit hard to see, but this is double underlined. And that's to draw the reader's attention to the bottom line figure. So the bottom line figure, whatever it is, gets a dollar sign and double underlining. Right? So that is a properly prepared income statement. Now let's just pretend that these two numbers were the reverse. Right, that we had 25,674.7 in revenues and 38,576.0 in expenses. If this were the case, it wouldn't be net income. It would be a net loss. And negative numbers in accounting, negative values, are shown in parentheses. All right, we show negative values in parentheses. All right, so this is what it would look like if the dollar amounts were reversed. Right. And quite honestly, it doesn't matter whether the dollar sign is inside or outside of the parentheses. That's just the way that Excel does it. Right. But don't have a negative number here and say net income, because it's not net income. You don't want to do that. Don't say net income and then show a negative value. Say net loss. What some companies do is they write out the final line of the income statement this way. They say net income slash loss with the loss in parentheses, so that the reader knows that if the number is in parentheses, it's a net loss as opposed to net income. You may see that in Wiley Plus. That's an alternative way of doing it. My personal preference is just to say whether it's income or loss. I think that's less potentially confusing to the reader. Let me take this back to the way that it was. All right. Now, it is worth noting, none of these expenses are in parentheses, even though we are subtracting these expenses from revenues. And that's worth a couple seconds of discussion. Unlike in mathematics, we do not indicate function by putting these numbers in parentheses. Right? In mathematics, if you're going to subtract, you put a minus sign. We don't do that in accounting. We just know that it's revenues minus expenses. We generally, with the exception of the statement of cash flows, which we'll talk about next week, we generally do not use numbers in parentheses to indicate mathematical function. When you see numbers that are in parentheses on financial statements, that's usually indicating a negative value. And these expenses are not negative values. There's no such thing as a negative expense. The least amount of materials and production expense that Merck can have is 0. There's no such thing as a negative expense. There's no such thing as a negative revenue. The least amount of revenue you can have is 0. So on financial statements, it's relatively rare to see numbers in parentheses. And it's usually just going to be numbers like net loss, because revenues are either going to be 0 or they're going to be positive values. Expenses are either going to be 0 or they're going to be positive values. So please don't think that you put a number in parentheses to indicate subtraction, because in general, we don't do that on financial statements. It's not a common practice. Again, with the exception of the statement of cash flows. That's one of the few financial statements that's going to have a lot of numbers in parentheses, but for a different reason. Okay. So that is a properly prepared income statement. Any other questions about our income statement? Ask them if you got them. A summary of operating activities. And we know from last time that the operating activities, revenues and expenses, revenues representing the inflows of cash and other assets because of the normal day-to-day activities of the business, expenses being the outflows of cash related to the day-to-day activities of the business. Okay. So you have a bunch of additional income statements and retained earnings statements on the additional practice exercise sheet that's posted in the handouts section of Chapter 1 Blackboard that you can do for extra practice. Right? And you're going to have to practice these. You're going to have to practice them to get comfortable with the process. Right? There was 1 decimal in this case just because that's how Merck decided to present the information. Doesn't necessarily just have to be 1 decimal. Could be 2. Usually companies don't do 2 decimal places because they don't want to confuse the reader into thinking pennies. Because typically when you see a number with 2 decimal places, you think dollars and cents. So it's much more rare to see more than 1 decimal place when you're doing something other than whole dollars. But I mean, theoretically, if Merck wanted to, it could have done it to 3 decimal places. Right? There'd be some theoretic reason to do 3 decimal places because obviously 27 is the billions, 428 is the millions. If you had 3 decimal places following, that would be the thousands. But usually it's just going to be 1. Any other questions? So we do the income statement first. Because information from the income statement is going to flow over to the retained earnings statement. And after we prepare the income statement, we then prepare the retained earnings statement. Now you have this retained earnings specimen on page 1-11 in your text. It is blessedly simple, a maximum of 5 lines, sometimes only 3 lines. And the reason it's such a simple financial statement is because it's a fake financial statement. It's not a real financial statement. Real publicly traded corporations do not prepare retained earnings statements. They prepare a document called a statement of stockholders' equity, because the statement of stockholders' equity is much more comprehensive. A retained earnings statement only tells us what happens to earnings over the course of a period. And as you know from reading the text, earnings are only one part of equity. All right? Equity comes from 2 sources. At least so far, we've encountered 2 sources of equity. Right? The cash that owners give to the corporation, we call that contributed capital. It's represented by an account called common stock. Common stock is a representation of the cash that owners pay to the corporation in exchange for their ownership interest, contributed capital. That's one source of equity. But we learned last time that the other source of equity is earnings, earned capital. The retained earnings statement only tells us about changes in earned capital. And quite honestly, you don't know enough accounting yet to be able to prepare a statement of stockholders' equity. Let me make this a little bit bigger. This is a much more complicated diagram. I haven't even covered this yet in intermediate accounting with my CPA track people. There's things on here: accumulated other comprehensive income, non-controlling interest. We won't talk about either of those 2 things the entire semester. We won't talk about treasury stock and additional paid-in capital until we get to chapter 11. You just don't know enough accounting yet to be able to learn how to prepare a statement of stockholders' equity. But it's a much more comprehensive document because it shows all of the changes in equity, not just the changes that come from earnings. So Merck does not prepare a retained earnings statement. We're going to finish up the Merck example here in a second. But in the real world, Merck does not do a retained earnings statement. They do a statement of stockholders' equity. And there's a column for retained earnings. One small part of the statement of stockholders' equity is retained earnings. But there's a lot of classifications here. 1, 2, 3, 4, 5, 6 different classifications on this one. Sometimes there's even more than that. So this is just a little bit beyond us. So the much more simple retained earnings statement is simple just because it doesn't do much. It just tells us how much earnings the company keeps to use for its own purposes and how much it gives back to the owners in the form of profit sharing. Now we're going to finish up Merck here in just a second, but I do want to make sure that you understand that this illustration, retained earnings at the beginning of the period, is 0, but it's only 0 because the Sierra example is an example that Kimmel uses in the text. And the first month in business for Sierra Corporation was the month of October. So normally this is going to be a dollar amount. It's only 0 in this illustration because in the Merck example, or I'm sorry, in the Sierra example, it was the first month in business. Right? But it's very simple. Beginning retained earnings, add net income, subtract any dividends if there are, and that gives you your ending retained earnings. The easiest financial statement to prepare. So let's finish up Merck. So, does retained earnings at the beginning of the period go on a retained earnings statement? Yes. So we're going to use this piece of information. And now we know that dividends are presented on the retained earnings statement. So we're going to use the dividends declared. So in this particular problem, we actually end up using all of the data points. But that's not always going to be true. So for Merck, we're not going to need as much space to do our retained earnings statement, but we still have to start with a header. Again, it's the name of the company in all capital letters. And we throw in the INC to indicate the legal form of organization. We have the name of the statement. And again, in the case of Merck, the modifier in millions or in millions of dollars. Since I did it in millions of dollars here, I should probably be consistent here. And again, the same time period. And they have to be the same time period. You can't have an income statement for the year and a retained earnings statement for the month. That's just not permitted. Right? But this is a much more simple financial statement. We're only going to need one of those two columns. So we're only going to need to use the rightmost of the two columns because it's just so much more simple. So we start with retained earnings at the beginning of the period. Our data set told us that retained earnings on January 1 were 43,698.8 in millions. Okay. And then the net income flows down because our very next line, we're going to add net income. So the 12,901.3 comes right on down. And we have a little hanging subtotal here. Even though we don't write any words on this line, we'll put in a little subtotal, 56,600.1. Now, if there were no dividends, this would be the third and final line of the retained earnings statement. And this would get a $sign. and double underlining. But we did have dividends. If we didn't have any dividends, retained earnings statement would be 3 lines. It would be super simple. But because we have some dividends for Merck, we need a little bit more. So less dividends declared. Right? Kimmel typically just calls them dividends. That's the account name that he uses. Another name is dividends declared. They're just 2 different names for the same account. Right? I typically use dividends declared because that's how I learned it. All right, so our dividends declared, 3,597.7 in millions. Merck was actually pretty generous when it came to dividends. That's a fairly high dividend payout rate. They shared a lot of their profit with their shareholders. Again, notice the dividends is not in parentheses because we're not using parentheses to indicate subtraction. In this case, we come right out and say, hey, subtract it. But there were dividends. There is no such thing as negative dividends. The least amount of dividends a corporation can pay is 0. There's no such thing as negative dividends. Right? And that brings us to retained earnings. December 31. Super simple. Nothing even needs to get indented because it's so simple. Again, this really is a fake financial statement. Real publicly traded corporations just don't do this. Why do we put January 1 and December 31? Just to help differentiate between the beginning retained earnings and the ending retained earnings. I suppose if you wanted to, you could say retained earnings beginning and retained earnings ending. That would probably be equally acceptable. Just to differentiate between the retained earnings at the beginning of the period and the retained earnings at the end of the period. All right.
So we, far right?
I'm sorry?
It all goes in the far right column?
Yeah.
Okay.
Yeah. Typically, the way financial statements work, as you go further to the left, the degree of detail increases.
Mm-hmm.
So this is just more detailed. This is more condensed, right? This just tells us the total amount of revenues. This tells us each individual revenue.
Okay.
So when we do the balance sheet, we're going to find that we'll use a 3-column worksheet, and we might have a 3rd column that'll show even more detail. So more detail, less detail, less detail. Or you can think of it as the further to the right that you go, the more combined things are. All right.
Okay.
So our bottom line figure, 56,600.1 minus 3,597.7 gives us 53,002.4 in millions. So $53 billion of retained earnings. And the bottom line figure gets a $sign and double underlining. So $sign at the top of each column of numbers, and the bottom line figure always gets a $sign and double underlining. But here is something that you are generally not going to see in a real financial statement. You're generally not going to see 0 value items. It's just a waste of space to say less dividends declared 0. We just generally don't do that. So that's why I said earlier that if there were no dividends, the third line would be the final line of the statement, because we're generally just not going to say less dividends declared 0. Just as we wouldn't say less marketing and administrative expense 0. Right? If it's 0, we're just going to ignore it. Right? So at most, your retained earnings statement is going to have 5 lines to it. And one of the 5 lines doesn't even have any words written on it. It's just a subtotal. Okay. But again, this is really not a real financial statement. The big publicly traded companies use statements of stockholders' equity. Right? So any questions on our retained earnings statement? Any other questions, I should say? So your practice exercises in Wiley go live today, your additional practice exercises. There'll be a few more income statements and retained earnings statements you can do there for practice. You also have the pen and paper practice exercises on Blackboard. And there's like 8, 9, 10 income statements that you can do for practice in retained earnings statements.
Are the answers going to be posted for the
Yes.
exercises?
Yes.
Okay.
As of today, normally the day we finish the chapter,
Okay.
I make the link live, but I'm actually going to make the link live today because we'll have completed most of the mechanical stuff today.
Okay.
And I want you to be able to do them for practice over the weekend.
Find them in the same spot?
Yes.
Okay. Thank you.
And they'll be in the document library too.
Okay.
So either place. Right. You can do in-class exercise 1-2 on your own for extra practice. The solutions will go live tonight. But let's talk a little bit about the balance sheet. Even though we're not going to learn how to prepare it in chapter 1, it is the financial statement that would be next prepared. And we prepare it third because end of the period retained earnings flows over from the retained earnings statement to the balance sheet. All right. But I don't want you to worry about preparation. That's chapter 2. All right. This is going to get changed quite a bit in chapter 2. It's going to look very different in chapter 2. This is a very simplified balance sheet. There are not very many classifications on it, which is why it's not very useful. But it is an illustration of one of the most fundamental relationships in accounting. The balance sheet is a big, giant illustration of something that we call the basic accounting equation. And this is the golden rule in accounting. This is the most important rule in accounting. Assets equal the sum of liabilities and stockholders' equity. And if you think about the life cycle of a corporation illustration that we did last time, this should look familiar. Because as we illustrated the life cycle of a corporation, we saw that how did a corporation get cash? It issued ownership to owners in exchange for cash. It took on ownership. It recognized equity. And that gave the corporation cash. And then it borrowed money. And that gave the corporation more cash. And then the corporation took that cash and used the cash to buy buildings and equipment and everything else that it needed. It is a true statement to say that ownership and debt, equity and debt, are the sources of all of the assets of a company. We saw that very vividly on Tuesday. Another way to think of it is that creditors and owners have legal claims on the assets of a corporation. How did that corporation get cash? It entered into a debt contract. It borrowed money. It entered into a contractual relationship to borrow money. And that contractual relationship comes with obligations. And if the corporation fails to meet those obligations, they are in breach of contract. And the creditors can take legal action. They can take very dramatic legal action. If the corporation doesn't pay interest when it's due, if it doesn't pay back the money borrowed when it's due, the creditors can force the corporation into bankruptcy. They can force the corporation to liquidate so that they can get their money back. Maybe not all of it, but some of it. So creditors have a legal claim on the assets of a business, and that's what liabilities represent. The legal claim that creditors hold on the assets of a business. Now, theoretically, owners have a legal claim as well, represented by equity. But it's what we call a residual claim. As I mentioned on Tuesday, the obligations that a corporation owes to its shareholders, not much. Shareholders of a corporation just cannot force the corporation into bankruptcy. There's no way for the shareholders to demand a dividend. There's no way for a shareholder to demand their money back. Creditors have much more legal rights than shareholders do. Shareholders stand at the back of the line. That's why the big publicly traded companies pay a lot more attention to their creditors than they do to their owners. But equity represents the theoretical claim on assets that's held by owners, whereas liabilities represent the claims of creditors. And again, we saw that debt and equity were the two sources of financing capital. Of course, we also learn in chapter 1, and we'll certainly talk about it more in chapter 2, that in addition to ownership interest, maybe I should go to this screen. In addition to ownership interest represented by common stock, equity is also enhanced by earnings. By earnings. All right. So retained earnings also enhances equity. And earnings, of course, as we know from just preparing the retained earnings statement, is net income minus dividends. Right. So the balance sheet is a very detailed illustration of that basic accounting equation. Now, every chapter has vocabulary words. At the end of every chapter, there's something called a glossary. I strongly encourage you to familiarize yourself with all the vocabulary words in the glossary. But I'm not telling you to memorize word for word definitions. And I'm never on a quiz or an exam or a homework, I'm never going to say, hey, give me the word for word definition of an asset. But in order to be able to do problem solving, you have to know what an asset is. You have to know where assets go, where they're reported. To answer a multiple choice question is going to use the word assets. It's not going to define it. You're not going to have a multiple choice question that says assets, oh, in parentheses, a resource owned by a business that provides future usefulness. You're not going to have that in a multiple choice question. You're going to have to know what an asset is. You're going to have what we call a functional understanding of the terms, of the vocabulary words. And a functional understanding, that's just a fancy way of saying be able to use it in a sentence. Know what the word means so that you can understand the context in which it's being used. But it is important to understand that assets represent future usefulness. An asset is a resource that has not yet been used. It's a resource that the business is going to consume or use in the future. And why are they going to use it? To engage in operations. And once they use it up, we call it an expense. Expenses are assets that have been used up in the course of operating activities. Once an asset has been used up, we call it an expense. Liabilities also represent the future. A liability is a future sacrifice. A liability is a future sacrifice that the business will have to make because of a contract that it entered into in the past.
So a liability is not the same as an expense, or is that only in certain cases?
Liabilities are not the same as expenses. They are completely separate. You might have liabilities that originate because of expenses, but maybe not. You can have liabilities arise because of assets. The liability is the result of a contract that obligates the business to do something, pay money in the future. So it's a future sacrifice that's related to something, some contract that the corporation entered into in the past. But it has not been satisfied yet. That sacrifice is going to happen in the future. And what do we call a liability that has already been satisfied? We don't call it anything. There is no word for that. Because once the liability has been satisfied, it's done, it's gone. Right? Equity, as we know, is ownership interest. And again, it's a residue. It's a residue. It's what's left over after liabilities have been satisfied. So you can actually write the basic accounting equation in a little bit different way. You can write the basic accounting equation as assets minus liabilities equals stockholders' equity. Because we really only know what equity is by knowing what it's not. It's not liabilities. It's the residual claim. So what you want to make sure that you do with those vocabulary words, those glossary words for every chapter, is a functional understanding of the terms. Right? Flashcards are really good, but don't try to memorize word for word definitions. Just make sure that you can explain it in a sentence. We know that dividends are profit sharing. We know that expenses are assets that have been used up in operations. We know that revenues are the increase in cash and other assets because of operating activities. So these are familiar to us from last time. So this is actually a very, very useful illustration. We often refer to this as an expansion of the basic accounting equation. And you see the basic accounting equation up at the top here. And this is very important too, because we learn it in chapter 1. We're definitely going to be reviewing it in chapter 2. Equity, a corporation's equity, comes from 2 sources. Contributions of owners, contributed capital, and that's represented, at least for now, by the account called common stock. This is a representation of money given to the corporation by owners. And retained earnings, as we know, is the money that's retained from operational profit. Net income, revenues minus expenses. This is the income statement right here. And dividends, obviously, profit sharing. So this, revenues minus expenses minus dividends, that's the retained earnings statement. So what this illustration does is it shows you how the financial statements link together. Net income is on the income statement, obviously, but then it flows over to the retained earnings statement, net income minus dividends. And retained earnings flows over to the balance sheet. So this is a very, very useful diagram because it shows you very graphically how the financial statements link together. All right. So let's do part of in-class exercise 1-3, which is going to put this illustration into practical application. All right. So give me a second here to get it open. All right. So in-class exercise 1-3. Now we're just going to do part A together, and you can do the other parts on your own for practice. But this is just putting that expanded basic accounting equation diagram into practice. We're going to work on making sure that we understand how the financial statements link together. Revenues minus expenses is the income statement. Net income minus dividends is the body of the retained earnings statement. And here's the balance sheet, the basic accounting equation. So for each one of these 4 corporations, we've got a missing amount. We're going to use the relationship between the financial statements to determine the dollar amount of the missing amount. And the instructions even give us a great little hint. It says first determine the change in equity, the increase or decrease in equity during the year. All right. And we have part of the basic accounting equation as of the beginning of the year. And we have part of the basic accounting equation at the end of the year. It's relatively easy to figure out what stockholders' equity is because we know that assets minus liabilities equal stockholders' equity. Okay. So we've got balance sheet information here. We've got income statement information here and retained earnings statement information here. Okay. So as long as we only have one unknown, we can solve for anything that would be missing here. Now, we'd have a problem if there was more than one unknown. But if there's only one thing that's unknown, it's pretty straightforward. All right? So we'll do Baylon together, and then you can do the other three on your own. We should have enough time to get through Baylon. All right? So we've got a little hint here. It says determine the change in equity first. And to determine the change in equity, we have to figure out how much equity there is at the beginning of the year and how much equity there is at the end of the year. All right. So the process for solving this unknown for Baylon, we're going to start by using our basic accounting equation to determine equity at the beginning of the year and then at the end of the year. But let's rewrite the equation. This is the normal basic accounting equation right here. Assets equal liabilities plus stockholders' equity. Let's rewrite it. Let's say assets minus liabilities equals stockholders' equity, because that's just a different way to write it. And that's going to be more useful for us because we know assets and we know liabilities. So step one would be to figure out equity at the beginning of the year. All right. We know that assets at the beginning of the year for Baylon are $540,000. And we know that liabilities are $324,000. So assets minus liabilities is going to be stockholders' equity at the beginning of the year. All right, and that's relatively straightforward math that you should have learned, I think, in grade school. It's certainly not calculus, just simple subtraction. Stockholders' equity at the beginning of the year is $216,000. We'll do the same thing to figure out equity at the end of the year. Assets of $670,500 for Baylon at the end of the year, minus liabilities of $292,500 at the end of the year, give us stockholders' equity at the end of the year. Stockholders' equity at the end of the year is how much? $378,000. So now we can figure out how much equity changes. And that was our hint. First, determine the amount of increase or decrease in equity. And why is that important? Because of this illustration. Equity is influenced by two things: changes in ownership, changes in earnings. Those are the two things that are going to affect equity over the course of a year. taking on more owners, taking more cash from owners, or having more retained earnings. And of course, from the retained earnings statement preparation that we just did, we know that that's net income minus dividends. All right. So the change in equity is nothing more than stockholders' equity at the end minus stockholders' equity at the beginning. Right, so that's 378,000 minus 216,000. So the total change in equity is $162,000. Now, to finish our work, we need to use what I call the change in equity equation. Now, you're not going to see that in the textbook. That's just what I call it. But all it is knowing what affects equity. What affects equity? More owners or more retained earnings. So the change in equity is additional owners, additional issuance of common stock. Common stock, again, is a representation of owners. Or more retained earnings. And we know that retained earnings is net income minus dividends. So the change in equity is equal to common stock plus net income minus dividends. And we can say, instead of net income, we can say plus revenues minus expenses. So as long as we only have one unknown, we can solve. All right, we just figured out the change in equity. The change in equity is $162,000. And that's going to be equal to our unknown change in common stock plus 177,975 in revenues minus 97,200 in expenses minus 36,000 in dividends. And we just have to solve for the unknown now. And as long as there's only one unknown, we can solve for it. We can do a little bit of algebraic manipulation. We can isolate the unknown. All right. So we can say that A, the additional common stock, is equal to 162,000 minus 177,975 plus 97,200 plus 36,000. Right? That's just isolating the unknown, isolating the variable. And when we solve, the additional common stock is 117,225. So this is a nice little exercise because it really ensures that you understand how the financial statements link together. This is the income statement, revenues minus expenses, net income minus dividends. That's the retained earnings statement. And then this is the balance sheet. So solving for B and C would follow a very similar process. For D, just got to work it backwards. And use these same 4 steps, you're just going to do it in reverse order. You're going to start by figuring out the change in equity. Then you're going to figure out equity at the end of the year, and you're going to back your way into equity at the beginning of the year, and then you'll work backwards to get to assets. So D is a little bit different than A, B, and C, but it's just working backwards instead of forwards. So you can work through the remainder of these on your own. The solutions for the in-class exercises, the link in Blackboard will be live today in a few minutes as soon as I get it all posted to Blackboard. So you'll be able to get nice, clean copies for the things that we did together as well as the things that we didn't do. And the solutions for the pen and paper practice exercises as well. So be productive over the weekend. Make sure that you continue with your reading. We're going to be moving into chapter 2 on Tuesday. A little bit left to do in chapter 1, not too much. First 15, 20 minutes or so of class on Tuesday will be chapter 1, but then we'll be into chapter 2. And we'll be talking about the balance sheet. Most of chapter 2 is the balance sheet. All right.
So what's getting added besides the answers?
I'm sorry?
What's getting added besides the answers?
Answers to the in-class exercises and answers to the additional practice exercises, as well as the video from today, of course.
Oh, you're not posting more? I thought you said you were posting more practice. Did I mishear you?
No, the practices are, the exercises themselves are already posted.
Okay, so just solutions.
Just the solutions have been grayed out up until this point.
On Wiley too, there's solutions?
There will be solutions in Wiley for the additional practice.
Okay.
I think in Wiley, I call them practice exercises.
Okay.
Or additional exercises, I call them in Wiley. But once you do your 4th submission in Wiley, then you'll have the solution.
Okay.
Of course, you're getting a lot of the solution as you go through the process because you're seeing the boxes change from red to green.
Yeah.
Get a little bit different kind of feedback with the practice in Wiley than you do on the pen and paper practice. Right. So nothing is due next week. All right, our first quiz is coming up next weekend, not this weekend. So we'll be talking a little bit about adaptive learning next week. So be productive over the weekend. Make sure that you're reading and do some additional practice in chapter 1. I'm going to go ahead and stop the recording.